Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Charles Schwab, and this is Long Verticals and Diagonals. And I thought today we're going to tackle an interesting topic that addresses the issue of affordability for some traders. We're going to be talking about a strategy known as a long call diagonal spread that some actually refer to as the poor man's covered call. I think that's an interesting title. I think we're going to modernize that title a little bit. Let's be a little bit more inclusive, and let's also recognize that for some traders, even if they have a large account, maybe they use a smaller portion of that portfolio to pursue income, which is what this strategy generally is all about. So it should be a really good discussion today. I'll set a more precise agenda for what we're going to be covering in just a second. But before we do that, let me say hello to everybody who's joining us out there in YouTube. A lot of familiar names out there, a lot of new names. So welcome to everybody that's new. But hello there, BLB 1111, Vincent, Will, Dom, Dennis, Robert, Sharon, Tanika's Corner, SSPM 3504, David, Bobby, BD Bald, Life in the Fast Lane, Ricebird, Deborah, and everybody else. Thanks for joining us, especially to those of you who are joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, though, again, I want to welcome you as well. And if you happen to be watching on the YouTube archive after the fact, if you're just watching the recording of this presentation, enjoy the show, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. Kicks off promptly at 11 Eastern. We'd love to have you here in the live stream. I also want to point out, for the benefit of those that are here in the live stream, we have another one of our coaches hanging out in the chats with us. It's a good friend of mine, Connie Hill. Well, Connie and I have been working together now for nearly 20 years. Connie brings a wealth of knowledge and experience to this discussion. So her role today is just to address any questions that I can't get to during the natural flow of the presentation. Thanks for being there for me, Connie. But let's get into this. And as we do, Connie and I want to issue an invitation to everybody out there. If you're not following us on X, if you have an account on X, give us a follow. Follow your favorite presenters from Schwab there on X. It's the best place to connect with those presenters in between these live streams. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS, and Connie has already posted those into the chat. Thanks, Connie. But let's also discuss the risks associated with what we're about to do. This is important information. Bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risks, including the loss of principal. One other thing that I should mention is any investment decision you make in your self-directed account is solely your responsibility. All right, so with that important information covered, let's set an agenda for today's discussion. A few things that I want to make sure that we address. This is an ongoing webcast series. Every Thursday we meet in the live stream, and we have a series of ongoing positions that have been taken in previous webcasts. So I want to take a look at least one of those today. I think there's one in particular that needs a little bit of attention today. I want to talk through that. That's going to be more for those that are watching us on a regular basis. But then we're going to shift gears into planning a new position for this example portfolio. And that's going to include a quick recap of what's happening with the stock market today. So we're going to just take a quick peek at what's happening with the S&P 500 to sort of get our bearings a little bit. Then we're going to get into this discussion of long call diagonal spreads, this thing that some call the poor man's covered call. It's a strategy that's sometimes employed to try to lower the price point on an income strategy. Now, I'm not a big fan of that title. How about we call this the, I don't know, smaller account income strategy? However, it's not very elegant, is it? I need to come up with a better one than that. Anyway, yeah, we're going to be talking about what a long call diagonal is, when a trader might choose to enter it or even exit it. And we're even going to be placing an example trade today on the Thinkorswim desktop platform. So let's go right to Thinkorswim. Now, this is a software platform that's available to you from your Schwab Online account. If you haven't seen Thinkorswim before, you can download it right from your Schwab Online account. Let me show you that. So if you're logged into your Schwab Online, just pop over here to the Trade tab and look for Thinkorswim Desktop. This is what we are using. You can click on that, and then you just scroll down a little bit, and there's a big blue button right here that shows you learn how to enable Thinkorswim. This will download the software to your desktop. It'll create a little icon on your desktop that looks like a little splash icon. And then you can just launch the software from there. You just use your Schwab user credentials, your Schwab username and password to log into that software. And here you'll find yourself on this very much, looking very much like what you're seeing now, okay? All right, so let's start off with our current positions. And I said there was one in particular. A few of these are bullish trades. A few of these kind of misbehaving as the markets have been pulling back. Not a big surprise there. But Amazon is the one that I wanted to look at today. This, just to recap for those that may not have seen the placing of this trade, this is known as a long call vertical spread, similar to what we're going to be doing today, a little bit different. But in this case, we bought some 220 calls, sold some 225 calls, creating a bullish vertical spread where we'd prefer for Amazon to be above $225. Amazon ain't anywhere near being above 225 right now. It's closer to 205. Not doing well. Let's go see what's been going on. Now, what you'll also notice is that we have 6 contracts on both sides of this spread. We started off with 11. We've actually pared down that trade. We saw this thing starting to go south on us, so we took off some of the risk, realized some of the loss, tried to stop the bleeding there. But we left some on so we can continue to talk through this. So just to revisit the logic of this trade, our trader, put ourselves in the shoes of our hypothetical trader, and we're going to jump in in our time machine and go back here to February 14th when we took the trade. This is when we bought these 11 verticals for $3.40 per share. That's on 1,100 shares. So a little bit south of about a $4,000 risk that we took here. But in any case, we took the trade here, and you might be able to recreate the logic for this just by looking at the chart. You can see this was a stock that was making its way higher, seemed to be bumping along this upward sloping trend line, possible price support just rising, and we took it right here. That's where we took the trade, thinking maybe the stock will keep going up. Maybe we can stay in this green. Now, if you're wondering where all these graphics came from, I just drew them on. There are drawing tools that are available right down here. I just drew all this stuff on here. But this green box was just to show us where we'd like to be. We would have preferred for price to continue to rise. That really would have helped this trade out. But what have the markets done since we took this trade? This was February 13th. I might have said 14th just a second ago. It's the 13th when we took this position. In any case, yeah, that was just about the peak in the markets, and those are difficult to spot. And yep, we started pulling back. So last week, we were looking at this position, seeing that it was starting to break down. We decided to get out of about half. Sold out of 5 of our 11 vertical spreads. We were only able to sell for 166. We paid 340, so that's a realized loss, but at least we aren't losing any more on those 5. Sometimes trading is about managing the downside of the trade rather than just realizing the fun of the upside. But we left on some contracts to see a couple of things. Maybe we could learn if the stock runs up, how a trade can reverse itself, or if it happens to fall back, the additional risk that is present. Yeah. So now with the benefit of hindsight, we can look back to last week with a little bit of longing and say, oh, wouldn't it have been nice if we just got out of all 11? These are the pros and cons of trade decisions that are made along the way. We kept 6 of these. So let's go see what they're doing. If we go here, here are the 6. You can see the difference between those. $1.24 and 66 cents. My rough math says that's pretty close to only being worth about 60 cents. Paid 340. Some trades just don't work out. Could this one still work out? BD Bald says, can you cover how you could add on an adjustment to this trade? In some webcasts, I will do that. In the interest of time today, I'm not going to be doing that, but let me point this out. If you want to go back and see previous webcasts where we've done that sort of thing before, and you can attend live webcasts in the future, do yourself this favor. Find this channel on YouTube. All right, you're actually already watching it right now, but we have a YouTube channel called Trader Talks Schwab Coaching Webcasts. You can actually subscribe to it. Just go right down below the video right now and click on that subscribe button if you haven't done that already. But our YouTube channel is where we host our playlists of previous webcasts. You can also join our live streams every day of the trading week. We have 6 to 8 live streams on a range of topics: trading, investing. You can join those here. But I wanted to point out a couple of things. First of all, I know that some of you are new to this platform we're using. It's called Thinkorswim. If I go to the playlists here, you'll see, as you scroll down just a little bit, hey, there's the guy that's talking to you right now. And it says new to Thinkorswim, start here. I've actually prepared a series of 8 lessons. You can just click on that view full playlist, and this will just walk you through using that platform in good detail. Now, another thing that we could do is go further down the playlist. If we scroll all the way to the bottom, somebody's got to be at the bottom. Happens to be this webcast series. So I'm going to go right down toward the bottom, and you'll see there are my previous webcasts, long verticals and diagonals, and you can view that full playlist and look through here. Look at this. Look at this right here, Beady Bald. Very different reasons to consider rolling an options trade. Yeah, some might call that adjusting, but that was the topic of that discussion. So a final thing. I don't want to abuse you with the navigation of this, but you had also asked Beady Bald, you had asked, how do I do a search for something of specific interest? Well, I'm going to be illustrating a concept here in just a moment known as a moving average. Let's say that somebody doesn't know anything about moving averages. Well, we can just do a search right here. This searches the channel playlists for moving averages, and you can scroll down and find your favorite presenter if you like. There's one, spotting stock price trend with 3 types of moving averages. There you go. All right. In any case, yeah, make sure that you're subscribed to the channel. But let's go back to our trade, decide what in the world to do with it. Now, for some traders, they may decide, boy, we're way down here. We actually need to get all the way back up here above 225. We're 20 bucks below where we need to be. And if we just hang on and move toward expiration, we're actually in maximum loss territory for this trade. Still have 60 cents of value. We could go pull back out of that trade, maybe. Or we could hold on. If we get a rally, could we make it back up to maximum gain? We could. That is not a highly probable scenario at this point. So I'm going, and Beady Bald says, I was wondering if you could type in a topic title. Absolutely. Yep. Anyway, I think with this one, I think what we're going to do is just try to extract remaining value out of it. We bought it for 340. Sorry, sometimes it doesn't work out. That's a fact of trading options. It's a fact of investing in general, right? But let's go to our monitor tab. And to close up a position, we can go right to our monitor tab. This is where we monitor the progress of existing positions. Right-click on that position, and then from the pop-up menu, select Create a Closing Order. This is going to create an order to get us out of the position that we're in. And in this case, we could get out of the individual sides of the vertical spread or just the entire vertical spread. That's going to be the option up at the top. So I'm going to choose that. Let's sell this vertical. Let's see what we can get out of it. Looks like it's closer to 57 cents. I'm going to say, you know what? If we can get out of this for 55 cents, good enough. 55 cents, that's $55 per contract, times 6 contracts is what, 380 bucks or something like that. So there's still some value left there. We don't necessarily just want to let that go to expiration. But let's click confirm and send here, see if we can get this order filled. Attempting to sell these 6 verticals. When we use a limit order, there's not a guarantee that the order will fill, but we're going to see if we can sell this. This is going to give us a max profit, a max loss. So did I say 380? It's actually 330. In any case, The maximum profit and maximum loss on this confirmation page would be if we were opening a new position. We're actually closing an existing position, so we don't worry about this. But one thing to bear in mind is that there is a commission to be paid that's going to chip into a credit if we're able to exit. Let's send that order off. And we'll just come over here to our monitor tab. We can see up here at the top, if we look at our working orders, this is now working, trying to get a 55-cent credit. It just filled. Sold it for 56 cents. All right. So we're done with that. If you're watching, this is a sort of an intermediate level presentation. I try to go at a pace that everybody can follow, but I recognize not everybody's at exactly the same point along their own personal learning curve. That's okay. These webcasts are recorded and they're posted. The vast majority of our webcasts are posted to that YouTube playlist archive, and you can go back and re-watch this and start to learn at your own pace the logic of what we're doing here. Okay? Harry says, where do we see what we paid originally? Harry, just like your bank account, if we wanted to see some historical transaction, we would get our account statement, right? That's where we'd go here, the account statement right there. So, Robert, good question. Robert's asking about what if we're assigned? I want to talk about assignment, but I'm going to use my next trade example to explore that so that we have time to thoroughly discuss this strategy that I want to talk about, okay? So we're shifting gears here. We've just managed an existing position. Let's go have a look at the markets and make a plan for a new position for our paper money portfolio. And I want to look at the S&P 500. We're just going to use this as sort of a stand-in for what's happening with the stock market in general. Not everybody uses the same index, but we're going to use the S&P, and we're going to look at it through the lens. We're going to put on our charting goggles for just a moment and see how might a chartist look at a chart like the S&P 500. Well, a couple of things that may stand out. Not everybody sees things exactly the same way. But first of all, yeah, these last couple of weeks have been a little bit rough for the bulls. The S&P hit an all-time high, and then we pulled back, what, about 7% from those highs, something like that. But one interesting development is that after that pullback, what have we touched these last 3 days? Look at those candles with their little tails sticking down like this. Each of them stretching right down to what we call a moving average. So what is this moving average, this green line? Well, this is simply showing us over time the average closing value of the S&P 500 over a 200-day period. So as of this moment, if you look over here in green, it says 57.31. That means that the average closing value of the S&P 500 over the last 200 days has been 57.31. And right now, we're just a shade above that. So what some traders might conclude with that information is, wow, average prices, well, most stocks out there, a lot of stocks out there, are trading very close to just an average level over the last 200 days, whereas 2 weeks ago, they were well above that trailing 200-day average. Now, you might notice this is actually not with one point in time. There's actually a line here. That's because that average value changes over time. As prices go up, obviously that average value can go up as well. So a couple of potential functions here using this trend line. Number one, some traders use it as a gauge of long-term trends on a stock or on an index. But number two is it can commonly act as price floors. So it can act as price ceilings as well when a stock or an index is trading down. But like if we were to switch this to, let's say, a 2-year chart, you can see the S&P has actually only spent a few days below this level in the last 2 years. So for some, they may think, ooh, this might be as rough as the last 2 weeks have been. Maybe it's time for the stock market to go up again. Now, it can do whatever it wants to do, right? It could rise. Robert says, what's the difference in terms of buying and selling stock between the 50, 100, 200-day moving averages? Good question, Robert. If this were a technical analysis discussion, I'd go deeper into the weeds on that one, but it's not. This is more of an options trading discussion. So what you can do is just do what I proposed a little bit earlier. First of all, make sure that you're subscribed to our channel. And go to the playlist and do a little search for moving averages, and you'll see discussions along those lines, okay? But a second thing that a trader might note here is that price has pulled down to a horizontal level of what was a price ceiling and now appears to be a price floor. Really, in the last 5 or 6 months, the S&P has not closed below about the 5,700 level. So let's just say, as we are putting ourselves in the shoes of our hypothetical trader, they think, this looks good. As bad as the last 2 weeks have been, maybe prices are set to rise again. So maybe their plan is, I'm going to go buy some stocks. Okay, that's fine. This is not a stocks discussion, but it sets the stage for this discussion. I want to bring up another stock, or a stock, and this is going to be the example for the rest of our discussion, Apple. You may see something very similar with Apple, rising price over time. Here's that 200 period moving average. We've recently pulled down to what may be a rising price floor, and actually it's even strengthening just today. Got off to a little bit of a softer start, but starting to rally. So let's say that our would-be investor there is thinking, I have an idea. I'm going to buy some shares of Apple, and I'm going to use those shares for a potential income stream by selling options against that position. Now, that would be a strategy known as a covered call. Chat in, let me know. Are you familiar with a covered call? Just yes or no is fine. And not everybody knows every strategy, so it's okay if you're not familiar with it. But just to start the process of pursuing an income through covered calls requires the purchase of 100 shares of stock. And that might pump the brakes for some traders right there. Because if we look at Apple, to buy 100 shares, that would be about a $23,690 investment. Close to $24,000 just to get the gears turning on this potential income strategy. Okay, all right, I'm seeing a lot of yeses, okay? Yeah, some are saying no. Well, when we own shares of stock, through the implementation of an option strategy, what we might be able to do is, while we own those shares, we may be able to enter into a contract with another market participant out there where we're collecting a payment from them, and in exchange, they have the right to possibly buy our shares from us. That's basically a covered call. But it can be a little bit pricey, or even for others, they might say, yeah, I can afford the $24,000. I just don't want to commit that much capital at this moment. Maybe they have a big portfolio, but they want to commit less to the trade. Well, there's a similar position to a covered call. It's not identical, but it's similar, known as a long call diagonal spread, where instead of buying the stock, we buy the right to buy the stock. And it enables that trader, once we have, even though we don't own the stock, we own the right to own the stock, now we can go pursue the same logic of selling other calls for income. So this is how that would work. Let's just sort of imprint this chart in your mind as we go construct this strategy. First of all, we have the fact that Apple seems to have been rising, and possibly our trader thinks it's going to go up some more from here. Momentum seems to be returning to the stock, but also looks like there's a near-term price ceiling up there around 250. Maybe they think we might get up to this ceiling. There might be some people bailing out at that point, and it could cause prices to fall back a little bit. Well, I'm going to plan a trade that involves, and let's keep this April 18th in mind. This red dashed vertical line is just one of the options expiration dates for April. That's going to play a role in this trade. But the first part of our trade, this is going to be our example strategy. Ooh, let's make this bold. Just makes it easier to see. It's known as a long call diagonal spread, and I'll explain that naming convention in just a moment. But it begins with buying a call. When a trader sees that a stock is likely to go up, they may just choose to buy a call. Well, maybe in this case, Our trader doesn't just expect the stock to go up for a while. They might think it starts to stair-step its way higher for an extended period of time. If I look at this on a longer-term chart, what if we look at this on a 3-week chart? Can you see what Apple's tended to do over a longer period of time? It tends to run up and then kind of go sideways and run up and then kind of chop sideways. And maybe our trader thinks it's going to go up for a while. So how about now again, just to revisit, we could just go buy the stock shares, but instead, I'm going to go buy a call. Oh, look at this. I'm going to hit the pause button on my comments for just a moment, because I just noticed in our chat, there's been a survey posted. We don't always get surveys, so this is kind of it's not an everyday opportunity. But for those of you who've never filled out one of our surveys before, I'm going to tell you something about them. They're super short. 2 multiple choice questions, just click, and you could be done. But there's also a comments box and a suggestion box. What I want to say is if you take the time to fill out that survey, that stuff comes right to me. I read through the data, I read the comments, and it definitely helps. All right? So do me this favor, click on that survey link right now. Don't fill out survey yet because you don't know how to give me you don't have enough information to give me an honest feedback about how you thought the session went, because we're not done. But fill it out when the session is over. Okay, very good. All right, but back to our discussion here. Let's say our trader thinks the stock is going to go up for some time. You know, hitting bumps along the way. That's just kind of the way prices tend to move, even if they're going up. And so how about we go out to, let's go to our trade tab, look down through our option chain, and I'm going to buy an example call contract out here for the 16th of January, 2026. That is 316 days is going to be the term of this contract. But for those 316 days, we're going to have the right to buy 100 shares of Apple. So we're not buying the shares, we're buying the right to buy the shares. And with the shares trading right now around 236, how about we have a look? Wonder how much we could buy the 235 call for. Looks like that's trading between 27.90 and 28.20. Well, okay, let's say we're able to get that for 28 bucks. So we're going to buy the 16th of January. Oh my, I have my, let's turn the caps lock off. Buy the 16th of January of 2026, the 235 call. And I said, maybe we can get that for 28 bucks. So what does that do for our trader here? Well, for the next 316 days, we're spending $28 per share. That's $2,800 for 100 shares. But for the next 316 days, we have the right to buy shares for $235. Wow. It's sort of a stand-in for stock ownership. We could have just bought the stock, but that would cost almost 10 times as much. It looks like about 9 times as much. Instead of spending $23,600, we're spending $2,800. But now that we have the right to buy those shares, we can pursue the income strategy typically associated with a covered call and go sell a call. So I want to just one more time. Janelle says that's a lengthy period for a contract. It is, Janelle. But if a trader thinks a stock is going to go up for a lengthy period of time, maybe they don't want their contract to run out of time while the stock is still going up. Also, it allows for that period of time this concept of selling other calls for income. But just to revisualize what we're doing with this long call, when we own a call, we prefer stock price to go up. Hey, that's what we expect. But we recognize it's not going to go up and just keep going straight up forever, even if it turns out to be quite bullish. More commonly, it'll go up and then it'll pull back, and it'll stair step up a little bit higher and it'll pull back, and it'll still stair step up higher and it'll pull back. So that may open the window of opportunity for an income approach to be added to this capital appreciation approach. So at the same time we buy this call, pardon me, I don't know why my voice is struggling just a little bit, you'll have to forgive me, but at the same time we buy this call, I'm going to sell another call right up here at 250. but not for 316 days. This one, let's go for a shorter period. Let's go to our trade tab. I'm going to go to maybe the 17th of April, and we're going to sell how about we go for the 250 call? I wonder what we can get for that. I don't know. We'll have to check. Let's look at the 17th of April of 2025. Look at the $250 calls, and those are trading between 360 and 370. Let's say we're able to sell that for 365. So what does this do? Okay, oh, never mind. Question came in and was taken away. George says, what if Apple goes down to 2? Good question, George. We definitely need to talk about the pros and the cons of this strategy. Yep, no doubt. Okay, but what does this add to our equation here? We're hoping that the stock price goes up, and the higher the better for our 235 call, because we've locked in a purchase price of 235 bucks. So if the stock happens to go up to 250, we have the right to buy those shares for 235, and this is starting to build value. But for this contract, what the trader is hoping for is the stock stays below that level at least through the 17th of April. I want to talk about if you haven't quite followed the logic of the trade just yet, that's okay. It's your first exposure to a long call vertical spread or diagonal spread. I just don't expect people to latch on to a strategy on first exposure. That's why we record these sessions. You can go back and think it through. But we do want to ask ourselves, okay, so what happens again if I set this up this way? What if the stock goes up? What if the stock goes down? How much can I make? How much can I lose? We're going to explore those scenarios. But before I do that, I want to talk about the naming of this strategy. It's known as a long call diagonal spread, right? There's the name. Why is it called a long call anything? Well, when we buy something in the world of trading, we say that we're long that thing. Hey, I bought some stocks. I'm long stock. I bought a call. I'm long a call. And in this case, we're spending $28 and then selling another call and receiving a credit of $3.65. So what's the net cost of this trade if that's where we happen to fill this order? It's going to be a little bit under $25, right? It'd actually be $24.35. But there's an expense here. It's a debit. So we'd still say we're buying net, so we're long. And we did that using calls, so it's a long call something. Well, it's known as a diagonal spread. And that's because there are two differences between the two contracts we're entering into. First is time. One expires in April, the other one expires out in 2026. There's a time distinction. There's also a price distinction. One is at 235, the other one's at 250. So if we're separated by time and by price and we try to draw a line between the two, at least to me, that paints a visual picture of a diagonal line. It's a diagonal spread, so a long call diagonal spread, okay? In any case, let's try to visualize what we want out of this. Beatty Bald says, it seems to me that it would be comfortable conservative if the current price is deeper in the money and do a risk diagram. Well, let's talk about what this could do from here. Let's say it does exactly what we expect. The stock goes up to 250, it kind of pulls back a little bit and winds up just down below 250. Well, if we have the right to buy shares for 235, and that extends all the way out to 2026, what this is now doing is it's giving us a better discount than we had on those shares on day one. Right now, we have a $1 discount, maybe about a $2 discount. If we're up here, let's say we're up there at 245. I'll use that. Well, if the stock's up at 245 and we have the right to buy it for 235, we're getting off on the right foot in this trade. That option is growing in value. So our long option is benefiting from the price having gone up. What about this one? With this contract, someone else has the right to buy shares from us for $250. If the shares are only worth $245 and it's April 18th. It's decision day. Did I put the 17th of April? Is it the 17th of April? Hold on a second. Let me check something here. Yeah, okay. Anyway, if we've gotten to the expiration date of this contract, it's decision time. That this trader who gave us 365 bucks has to decide, well, am I going to buy Cameron's shares or not? Well, the shares are only worth 245. They have the right to buy from us for 250. Are they going to do it? Almost certainly not. Could they if they wanted to? Theoretically, yes. But this contract would be what we call out of the money. So in that case, our long call will have increased in value. Our short call just expires worthless, and that 365 that we collected up front becomes a realized gain. And we no longer have a ceiling. If the stock continues to rise, hey, that just continues helping the long call, and we don't have the short one in the way, basically. So that's if the stock goes up, pulls back, it's just below 250. Well, let's talk about a little uglier scenario, because somebody said, what if it goes down? All right, let's suppose the stock collapses in value. What if it goes down to 220? Because somebody else said 220. I'm going to use their example. Okay, can't remember who said 220, but let's do that. Well, if the stock is down here at 220 and we have the right to buy shares for 235, that's no great benefit, at least not yet. Now, there's still lots of time left on that contract. Could it recover? Yes. But what do you think has happened to the value of this contract that we bought? We might think back in the day, boy, I had 316 days on this, lots of time potential, and we thought the stock was going to go up. It's not going up, it's going down. That call is getting hurt. Now, the other one, though, someone has the right to buy shares from us for 250. Those shares are only worth 220. Are they going to say, Cameron, out of the kindness of my heart, I'm going to bail you out of this terrible scenario, and I'm going to buy your shares for 250, even though they're not worth anywhere near that? No, they're probably not going to do that. That would be highly uncommon. So they just walk. They say, Cameron, keep my 365 as a little consolation prize for your damage that you took on this. This would be an unprofitable scenario. So we do not want to go down. I'm going to draw a line here at where current price is. We don't want to go down here. Let's draw a box there. Let's edit its properties and say this is sort of the no-fly zone. We don't want to go down there. It's not that it would be absolutely devastating, but the further the stock goes down, the more this might lose money, because this call has a limited ability to make up for the damage that we take on this one. Where we'd really like to be as we move forward in time is to go up here. Up here is our profit territory. I'll just leave that green. John says, do you have to get out to trade to get out of a sold call, or will it just expire? John, yeah. An out of the money contract just expires at expiration unless the owner gets a wild hair and decides to assign the contract. Now, assigning an out of the money contract actually sounds terrible, but it would be somewhat in our favor if somebody chose to do that. Still a possibility. It's a good question, though, John. Yeah, if we're below 250 to any extent as we're getting close to expiration, this contract just expires worthless without any action that we need to take, unless it gets assigned. That's just an unusual outcome. Anyway, yeah, where we'd like to be is for the price to go up here, but where we'd really like to be is in this zone, just for the next little period. Let me edit the properties of this rectangle and make it a little bit darker green. That's where we'd really like to be. There's one other scenario we haven't talked about. So what if the stock goes down? What if it goes up, but it's still below 250? Well, what if it just goes up and keeps going up? What if we go whoop and let's say we shoot up here to 260? In this case, We have the right to buy shares for $235. Great. We have a $25 discount on the stock. That's doing awesome. But someone else has the right to buy shares from us for $250. They're now worth $260. Anytime before expiration, or particularly at expiration, is that contract going to be assigned? Yes. Yeah. At expiration, this contract would be in the money, and in the money contracts are automatically assigned. So in that case, we might wind up having to buy, having to sell some shares. Someone has the right to buy shares from us for $250. And in that case, we could wind up short some shares. And you might think, oh, so we just exercise this contract, buy shares for $235 that we just sold for $250, and that closes it out. Probably don't want to do that. In most cases, the trader would probably just want to buy out of buy to cover the short position on the stock. But those are a few potential outcomes. The ideal outcome is for the stock to go up. It's not too far. Okay, so let's talk about when do traders take these positions and when might they exit them? Well, commonly, these trades are initiated when the stock is down near a price floor. That's the logic of this trade, and that's the logic of a number of these sorts of positions, where we think the stock is about to go up, and we buy the long call when the stock is down near a price floor, sell the short call up above where we think the next ceiling is, at or above that ceiling. So there's sort of an entry that's kind of common. Well, what if the stock starts to misbehave in one way or another? What if we start to collapse downward? That's not ideal for this trade. Well, if the trader has decided that they are no longer bullish on the stock, and this is a bullish strategy, maybe they might want to look at exiting this strategy. Take their lumps, whatever those lumps might be. Or what if the stock is going up, but it's gone beyond that short strike, and now it looks like we might get assigned? Well, in that case, they may decide to buy back that short strike. Might cost them more than they received for it initially, but it just allows the long to just continue to grow without an obligation to sell at the short strike price. In any case, let's go place our trade. Let's make sure that we get that done. And we'll talk more about managing these trades in future webcasts in this series. So make sure that you're joining us on Thursdays. You can join us Thursday, 1 Eastern time is where 11 Eastern time is when we kick these webcasts off. But let's go place this trade. And on Thinkorswim, here's a quick way to place this sort of a trade. Doesn't really matter the order in which we do this, but since we're here on the 17th of April, the short option strike expiration, let's go to the 250, and I'm going to click on the bid price to create a sell order. That prepares an order to sell a contract. Now, I'm going to hide that order, and I'm going to go out to the 16th of January. And let's go down to the 235 that we were using as this example. And I'm going to hold down the control key on my keyboard and click on the ask price. Clicking on an ask price creates a buy order in Thinkorswim. And so you look at that, it added our buy order to our sell order, buying the 235, selling the 250. Looks like our net debit might be around $24.30 at this moment. Let's say that we're willing to spend up to that $24.50 for the natural price. But I'm going to click confirm and send, and we're going to put in an order to buy this diagonal spread. Now, the maximum that we can lose is if the stock goes down and we hang on all the way through 316 days or whatever, and the contracts just expire worthless. We could lose the full investment here, so that's a risk. There is a commission to be paid here, $1.30. I'm going to send that order off, and we're in. So there we go. All right. So from here, we'll see how this trade goes. We just entered into something similar to a covered call, but at a fraction of the price, literally about 1/9, actually net about 1/10 of the cost of getting into a covered call. Still has that income potential. But everybody, this is what we do on Thursdays. I hope you put it in your calendar to join me. I'm going to let you go enjoy the rest of our webcasts through the rest of the day. But as you go, just remember, do yourself a favor on a couple of points. Number one, make sure that you are subscribed to our Trader Talks channel. Trader Talks Schwab Coaching Webcast. You can go down below the video right now. Click on the subscribe button if you haven't done that already. That subscribes you to the channel. And this is where you can find the playlists for our previous webcasts. You can join our live streams right here. Now, another thing that you'll want to do is if you have an account with X, follow me on X. Also follow Connie on X. You can find Connie here on X at Connie Hill CS. You can find me here at Cameron May CS. But you can see this is the best place to connect with your favorite presenters in between the live streams. And you can also have some interaction, with those presenters. You can get updates from me and from Connie and your other presenters on what's happening in more real time than waiting around for the next webcast. So yeah, give us a follow there. It doesn't cost anything to follow. It doesn't cost anything to subscribe. But a final couple of things I want to point out. Number one is go fill out that survey if you would. That would be very much appreciated. Thanks, Connie, for reposting that. And I want to thank, out of the 500 or so people that are watching right now, there are 92 that have already clicked the like button. Make that a habit. If you enjoy a webcast, make sure that you give it a like. It shows applause to your presenter, and it boosts that webcast in the YouTube algorithm, helps more people find our webcasts and learn. Everybody, thanks for giving me your time today. Go enjoy the rest of our webcast. I'll look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.